All right, let's talk about a company you've probably never even heard of, TE Connectivity. But here's the thing, I can pretty much guarantee their products are all around you right now. I mean, they're inside your car, your coffee maker, the massive data centers that make the internet, well, work. They're like the hidden nervous system of our modern world. So the big question for us today is, does being that essential make this hidden giant a great investment?
So let's kick things off with a really interesting question. A bit of a puzzle, really. What if you find a company that seems perfect? It checks every single box. It's incredibly well run, it's super profitable. But what if that still doesn't make it a smart buy? That's the paradox we're going to dig into today. And to figure this out, we're not just going to wing it. Nope. We're going to use a legendary framework. We're talking about Warren Buffett's famous checklist for finding what he calls a wonderful business. It's an amazing tool, really, for just cutting through all the noise and getting straight to what actually matters. So here it is, the four tenets. Super simple, but so powerful. Number one, is it a business we can actually understand? Number two, is it run by people who are both honest and good at their jobs? Three, are the financials rock solid? And finally, the big one, number four, is it available at a fair price? We're going to put TE connectivity through this exact gauntlet and see how it holds up.
Okay, let's dive in and start with the good news. And spoiler alert, there's a lot of good news when it comes to this company. You're about to see just how brilliantly TE Connectivity stacks up against those first three rules from Buffett. But first, we've got to talk about a really key concept called an economic moat. Now, if you're not familiar, just think of it like a castle's defense system, right? A big moat with crocodiles in it. It's that durable, lasting advantage that protects a company from all its rivals and lets it rake in those profits for years and years. And let me tell you, T Connectivity's mode is seriously wide and deep. Here's why. Their components aren't just off-the-shelf parts. They're custom designed, engineered right into their customers' big, expensive products, like a new car or a giant industrial machine. And that's the absolute key. Once T's part is designed in, it becomes incredibly expensive and super risky for that customer to even think about switching. This creates what we call high switching costs, and that gives them real pricing power and these long-term, locked-in relationships. So for Tenet 1, a durable competitive advantage, that's a huge fat checkmark. All right, next up, tenet number 2. Do they have honest and able management? And the team at TE, they get top marks here for sure. They have a fantastic track record of just making smart, rational decisions, selling off weaker parts of the business, making really strategic acquisitions, and consistently giving cash back to shareholders. So, yeah, that's another big checkmark in the box. Now for the third tenet, the financials. And this number, this right here, really tells the story of the company's quality. We're looking at return on equity, or ROE. Basically, it shows how well a company uses your money, shareholder money, to make a profit. TD's 5-year average is hovering right around 22%. I mean, that's well above the 15% that legendary investors like Buffett even look for. This is the sign of an incredibly efficient profit-making machine. And get this, they do it all without taking on a bunch of crazy risk. This debt-to-equity ratio of just 0.5 is super conservative. It just means the company isn't loaded up on debt. It's funding its own growth mainly through the money it earns, which is exactly what you want to see in a business that's built to last. And this chart, this really seals the deal on their financial strength. Just look at that steady climb in free cash flow. That's the actual, real cash the business generates. It's gone from $1.6 billion to $2.3 billion in just 5 years. This is the good stuff. This is the fuel that powers everything else: dividends, buying back shares, and smart reinvestment back into the business. So when you step back and look at the business itself, the management running it, and the financials, well, the conclusion is pretty unavoidable, isn't it? TE Connectivity is a stellar, high-quality, absolutely wonderful company. It passes those first 3 of Buffett's tests with flying colors. Which, of course, leads to the million-dollar question. If this company has such a glowing report card, why isn't this just an automatic slam-dunk buy? What could possibly be the one missing piece of the puzzle here? And here we have it, the one missing piece. It all comes down to Buffett's 4th and, frankly, most crucial rule: the price you pay. Because even the most wonderful company in the world can be a terrible investment if you overpay for it. And to really get this, we have to talk about the margin of safety. This might be the single most important concept in all of value investing. It's simple.
It's the discount you get when you buy something for less than it's actually worth. It's your cushion. It's your buffer against bad luck, or, let's be honest, just being wrong about something. The bigger that margin, the safer your investment. Okay, so let's apply this directly to TE. On the left, we have the estimated intrinsic value. That's what we think the business is really worth, somewhere in the ballpark of $145 to $165 per share. And on the right, well, that's the price on the ticker today, about $155. Are you starting to see the problem? Yeah, the problem is this number right here. The market price is trading smack dab in the middle of our fair value range. There's no discount. There's no cushion. Your margin of safety is, for all intents and purposes, zero. So, this brings us to our final verdict, where we have to balance these two things that are both true at the same time. On one hand, we have a truly wonderful company, but on the other, it's only trading at a fair price. Not a bargain price, not a great price, a fair price. And that leads us to a bit of a nuanced recommendation. Look, if you already own shares in TE Connectivity, the verdict is pretty clear: hold. You own a fantastic business, so you just sit tight and let it do its thing. But if you're a new investor standing on the sidelines thinking about jumping in, the advice is to avoid, or at least wait. You wait for a market dip, a temporary piece of bad news, anything that gives you that all-important margin of safety. And really, the key lesson here is so simple, but it is so profound. It's something every single investor has to learn, sometimes the hard way. Finding a great business is only half the job. That business only becomes a great investment when you can buy it at the right price. And it all comes back to this one powerful idea, which just perfectly wraps up everything we've talked about today. You can do all the homework in the world, find the absolute best company on the planet, but in the end, the price you pay will decide your fate. In investing, what you buy is important, but what you pay for it is decisive.